Good day, everyone. Welcome to Module 2 of the analysis of the Nigerian Tax Bill. In this module, we will be looking at Chapter 1 and 2 of the Nigerian Tax Bill 2024. The Nigerian Tax Bill 2024 is a transformative legislative proposal designed to overhaul, unify, and simplify the country's tax system. By repealing outdated laws and consolidating them into a single Nigerian Tax Act, the bill addresses the complexities, inefficiencies, and gaps that have characterized Nigeria's tax landscape. It introduces measures that align with modern economic realities, including digital transactions, international business, and sector-specific considerations to promote compliance, encourage economic growth, and foster a balanced tax regime. Now, let us look at Chapter 1, Objective and Scope. This foundational chapter sets the tone for the bill by outlining its purpose and applicability. Objective: the bill repeals and consolidates existing tax laws into a single framework to standardize tax treatment across income types, transactions, and economic sectors. The goal is to simplify tax administration and eliminate the ambiguities created by fragmented law. So let us look at the scope. The Act or the bill applies nationwide, covering individuals, that is residents and non-residents, earning income in Nigeria. It also covers businesses, corporate entities, and partnerships, both non-resident entities, taxpayer with significant economic or permanent establishment in Nigeria, that is with respect to non-resident entities. These are taxpayers with significant economic presence or permanent establishment in Nigeria. Now, the framework ensures that every taxpayer is subject to consistent rules regardless of their location or the nature of their income. Now, let's move to Chapter 2. Chapter 2, Taxation of Income. One, we'll be looking at corporate tax. Corporate entities are taxed on their global profits provided they are attributable to Nigerian operations, and this includes income derived from local and foreign sources by resident companies, profit earned by non-resident companies through permanent establishments or significant economic presence in Nigeria. Now we'll look at the key provisions now. Let's look at the key provisions. The tax rate for small companies. The tax rate for small companies is set at 0%, while larger entities face rates between 25% and 27.5% depending on turnover and sector, with a phased reduction by 2026. So what it means is that small companies are exempted while larger entities face rates between 25% and 27.5% depending on turnover and sector, with a phased reduction by 2026. Now, with respect to individual income tax, income derived by individuals is subject to tax, including salaries, allowances, royalties, dividends, rents, and interest. Gains from property or digital assets, e.g., cryptocurrency, NFTs, are also subject to tax. This ensures that taxable income includes traditional and digital earnings, reflecting Nigeria's adaptation to evolving economic activities. Now we move to special provisions for non-residents. Now the bill introduces tailored rules for non-resident taxpayers. So non-resident taxpayers with a significant economic presence or a permanent establishment in Nigeria are taxed on profit attributable to Nigerian operation. Withholding taxes serves as a final tax on payments made to non-residents who do not meet the significant economic presence or permanent establishment threshold. Now, the impact of this is that these provisions ensures that foreign entities benefiting from the Nigerian market contribute fairly to the country's tax revenue. Now, let's move to determination of profit and deduction. Allowable deductions. The bill permits deductions only for expenses directly related to generating taxable income, such as employee compensation, pension contributions, bad debts, subject to strict condition. You can see that bad debts is subject to strict conditions. Now, for non-allowable deductions, certain expenses are explicitly disallowed, including capital expenses, fines and penalties, taxes on profit, payments to connected person that violate transfer pricing regulation. That means payment to connected persons that are not at arm's length, which violate transfer pricing regulation. Now, the objective of this is to ensure transparency and prevent profit shifting or excessive deduction that could erode Nigeria's tax base. Now, on number 5, taxation of assets and gains. Now, chargeable gains from the disposal of both tangible and intangible assets are taxed or are taxable. This includes currency gains, shares, rights, and other forms of property. Now, with respect to indirect asset transfer, taxation extends to indirect ownership transfers, such as shares held by non-residents that result in a change of ownership of Nigerian entities or assets. Now, these provisions aim to capture taxes on profits generated through asset transfers that have economic effects in Nigeria. Now, we'll be looking at taxation on corporate dividends and special entities. Now, for corporate dividend distributed by Nigerian companies are included in taxable profits. Specific rules govern tax rates and exemptions for dividends to ensure fairness and compliance. With respect to special entities, entities like insurance companies, lotteries, and mining operations are subject to tailored tax rules such as deductions for unexpired risks, that is with respect to insurance company, mandatory provisions for environmental protection, that is with respect to mining. And the objective of this is to account for the unique characteristics and risk associated with these sectors. Now, let's move to tax rates. Now, for corporate tax rates, small companies, like I said, 0% tax rate to encourage growth. Other companies, 27.5% with a phased reduction to 25% by 2026. Now, with respect to development levy, a progressive levy on corporate profits to fund education and technology development. The levy rate varies annually, ensuring targeted contributions to national development priorities. Now, with respect to miscellaneous provisions, collective investment schemes, that is income from mutual funds, is treated as shareholder income. Profits are allocated proportionately to unit holders, ensuring fair taxation. Now, on taxation in special zones, entities operating in export processing zones and free trade zones enjoy special tax exemptions, reduce rates to incentivize rates to incentivize trade and investment. Let me take that again. Reduced rates to incentivize trade and investment. Now, to number nine, simplification and compliance measures. So, for example, presumptive tax regime. For taxpayer, under presumptive tax regime, for taxpayers who are unable to maintain, or for taxpayers unable to maintain proper records, the bill introduces a presumptive tax system based on estimated profit. So taxpayers who are unable to maintain proper record, the bill introduces a presumptive tax system based on estimated profits. This measure simplifies tax compliance for small businesses and informal sector participants. Now, the effective tax rate floor, which talks about companies with an effective tax rate below 15% must pay additional tax to meet this threshold. So companies with an effective tax rate below 15% must pay additional tax to meet this threshold. And this ensures fair tax contributions and prevents under taxation of highly profitable companies. So let's look at the analysis and implication of all these summary. Now, the analysis and application of all this summary is: one, transparency and simplification. So by consolidating the tax laws, the bill simplifies compliance for taxpayers and reduces administrative burdens for tax authorities. Now, number two is adaptability to modern economies. Now, the inclusion of provision for digital assets, indirect transfers, significant economic presence reflects Nigeria's commitment to align with global tax practices. Number three is promotion of economic growth. So exemption for small businesses and special zones encourage investment, innovation, and job creation. Number four, equity and fairness. Now, the progressive development levy and effective tax rate ensures that taxpayers contribute equitably to national development. Number five, encouragement of compliance. The presumptive tax regime and withholding tax measures the withholding tax measure incentivize compliance, particularly for small businesses and non-resident companies. Let me take that again. Encouragement of compliance. So the presumptive tax regime and withholding tax measures incentivize compliance, particularly for small businesses and non-resident companies. So in conclusion, the Nigerian Tax Bill 2024 is a forward-thinking legislative framework designed to address the complexities of a modern economy by focusing on transparency, equity, and adaptability. So the bill positions Nigeria as a competitive and compliant player in the global economic landscape. And through its comprehensive provisions, the bill simplifies compliance, aligns with international standards, and foster economic growth while ensuring that the tax system remains fair and inclusive. So let's look at a call to action. Call to action now is that all taxpayers, businesses, and non-resident entities should familiarize themselves with the provisions of the bill to optimize compliance and benefit from the incentives provided. Consulting tax professionals is recommended to navigate the complexity and opportunities presented by the Nigerian Tax Bill. Thank you very much and see you at the next module. Thank you.